Where's this from?
True, from IDF.
All right, I'm calling the meeting to order. If my colleague Alan would sit down. Hi, Josephine. All right, so do I have a motion to approve the minutes from the August meeting?
I so move.
Thank you. Is there a second?
Second.
Perfect. Any discussion? All in favor? Any opposed? All right, that has been done. Okay. Is there an agenda?
It is, it's right under it. It's right on. Look up.
Oh, I'm sorry.
You have 2 sets of minutes to approve.
Oh, we should have done them together. Anyway, okay, let's approve do I have a motion to approve the minutes from May?
I will move that we do that.
Thank you.
Second.
All right. Any discussion? All in favor?
Aye.
Any opposed? Motion pass. All right. We are at documents. We've done that. I think, Tom, you're up. Perfect. Place is just too high tech.
Yeah, I'm trying to figure it out still, so patience.
It's all good. What's that? That's very true.
Sorry. Thank you, sir. Okay, so today, about as exciting as it gets for us, talking about asset allocation. So that'll be kind of towards the end of this. Do have performance through the third quarter. As always, we have the market environment up front. Not going to torture you with
you.
that. If you go to, actually, before we do that, if you just flip a couple pages in, our cheap plug for our market preview here in St. Louis every year.
It's not cheap, it's an expense, it's cheap.
Okay, that's fair. Fair enough. So it is, we have folks from Chicago in our research department that come down here. We have, about an hour and a half of program, just kind of talk through different asset classes, outlooks and all that. So it's, Alan's been there a few times. So if you can make it, please do. You'll probably get emails bombarded with us from emails on it. So we'd love to see you there. Exhibit 1, running through the third quarter. I've turned to page 1. No issues with any of the managers. Flipping over to page 2, market value. Excuse me. I'm in exhibit 1, page 2.
Oh, okay.
So total fund composite, $21,111,118. You can see any cash flows during that particular period. We are underweight fixed income. I have a couple underweights elsewhere, some overweights, and one note down there in real estate. You want to?
Yeah, sorry, I wanted to mention that you all put in a redemption for $500,000 from the principal real estate investment, and we finally got a first payout from that, $45,000, about 9%. Thankfully,
Yeah,
it's something.
we're starting.
And just so you know, that went to the region's cash account, and that's earning. We didn't show it on the report for a long time because cash was earning almost nothing. Right now, it has a 5.27% current yield. In terms that most people understand, it's about 0.45% a month, or about 1.3% a quarter as of now.
So as we get more, we'll, transfer those to the core fund.
Those are quarterly redemptions?
Well, yes,
Yeah.
hopefully. I mean, I can't guarantee next
Sure.
quarter, but not in this report. Also, just about as long as we're talking about principal. So they give monthly returns, which is a little uncommon for private real estate. They did have a positive tick in the month of October. I'm not going to say that that's going to continue, but it happened. So we have to celebrate that. Hopefully we're kind of getting towards the end of the swoon on real estate. So actually a couple things obviously that weren't happening just a couple of months ago with money in, money out, and a positive return. So if we turn to page 5, just a quick look at cash flows and dollars in, dollars out. You can see where we started the particular quarter, a little over 22 million, 22,166, the net cash flow out for benefits and expenses. And then you see net investment change was negative 603,000. The quarter overall, not too many places to hide. Basically, if you were in money market or any type of floating rate debt, those were positive. Everything else took a pause during this particular quarter. You can see all the other time periods going back in time. Jumping ahead to 8 and 9. So you can see September, before September, we were looking at a positive quarter, but September kicked off. US got downgraded, not that that directly did anything, but that just kind of set a sour mood for the month. And obviously it was just kind of became a cavalcade of risk off behaviors during September. So for the quarter, the fund was down negative 2.8%, ranked at the 37th percentile of similar sized public plans. Year to date sitting at 3.7, a little bit behind the benchmark at 3.9. And I'll talk about kind of where we're underperforming. Fixed income, you played good defense in this environment for the quarter, down negative 1.1 versus negative 3.2 on the ag, and actually a positive return against the negative ag. So good performance, relatively speaking there. Going down the list, you have principal in many of these. Obviously, you have principal core. That's done what we wanted to do from a core perspective. Core plus, sold off a little more than core in this environment, not a surprise. You have high yield on the principal side, which this year is up 6.1%. Then you have preferreds, which have kind of cooled off recently. You can see 1% for the quarter and year to date up 0.9. And then lastly, the non-principal fixed income, Pacific floating rate, that's been great. Obviously in this environment, that's up 3.3 for the quarter and year to date up 10.4. So it's been a good addition. US equities, this is the main underperformance in the portfolio. So 3 months, negative 4.2 versus negative 3.3, and year to date down about 400 basis points, a lot of that being earlier this year. So those of you in the business, you understand the market dynamics of basically large cap and those 7 stocks dominating. So anytime that we deviated from that, you are going to pay the price this year. Obviously the S&P 500 index, that's fine. That's doing exactly what we would expect it to do. And obviously that has a large bulk of those 7 stocks. Then you get into the other lower cap and style weights that obviously do not have those. So you have the mid cap value, which was down 4.9. Year to date, mid cap value through September was actually negative. And then mid cap growth was down 5.3, year to date up 8.9. And then you get down to small cap value up 2.1 year to date. And then you have growth, small cap growth up 7.3. So anything outside of that, of the basically, those 7 stocks have seen some struggles this year so far. Page 9 is non-US, protected a little bit during the quarter. Year to date, a little behind. You have the Vanguard Total International Stock Index. That was down 4. And then year to date, up 5. On the small cap side, negative 3.4. And year to date, up 4.3. And then EM, negative 2.2. And year to date, up to 2.5 there. And then alternatives, we said real estate for the 3 months ending September, still negative. That was negative 4.0. And then year to date, negative 8.9. Further you go out, obviously you see more normalized returns. And then private equity positive for the quarter, positive 1.4. Year to date up 6.7. So obviously this has been also a good diversifier that you added a little over about almost 2 years now at this point. So obviously,
But those numbers are lagged, aren't they?
those are the returns for the quarter. I mean, that's the quarterly return.
Okay.
Yeah, I mean, that's we get a statement that says you're up 1.4% for the quarter.
Okay.
Yeah.
Okay.
So and in that private equity, I mean, it has a lot, it has also has infrastructure investments. It has some income generating investments within there. So it's very well diversified, which obviously been helping in this environment.
But yeah, as of this report, it was the Partners Group investment was as of the end of August. It's lagged by a month.
That's what I'm saying.
Just a month.
It's
A month.
different, yeah,
Yeah.
This might get back to the
but
correspondence today.
that's a big lag because September sucked. Excuse me, I shouldn't put that on. But that's what I'm saying. It's
Yeah.
not apples to apples.
Yeah.
Quite apples to apples.
The fact that we're up 8.6% versus the index of 12.4 on equities and we're indexing everything, does that get back to the benchmark of the Russell 3000 that we're using? And the
Yes.
fact that our weightings are different?
Yes,
Okay.
there is, so I had it, actually I have it in my phone here. So just like I said, small cap, so small cap, your US equities your small cap is about 24 and rounding % of your US equity allocation. So call 25%. Small cap on the Russell 3000 is roughly about 9%. You're making a bet there. And as I mentioned earlier, you did that for a reason, because one, you had to hit 7.25%. Two, you were also kind of had your hands tied because you had to keep assets at principal no matter what. So you couldn't really take your fixed income down too much because you needed to make sure that you kept the cushion there. So in order to do that, when we kind of went through our system just to, show your actuaries that we can project a 7.25, you, like many others, you had to do some overweights on small cap, and, even EM and that, just to kind of justify what you're doing to try to get to those returns. Other plans in the past few years, obviously now we're looking a different direction, but you go back a few years, similar pension plans were down in 20% or even the teens of fixed income allocations. You really couldn't do that because you had to play the game with principal to keep assets there, to keep the cushion there. So there's obviously reasoning behind why you made some of those bets. And, when we look, we'll talk in a little bit, we think maybe you could look at trimming some of those bets a little bit, because that's a pretty big bet. And if you go to the back here for your minutes, let's go to page 30. Yes, we're still in the report in Exhibit 1. Just looking at your fees within here. So you have all your various investments, their fee schedules, and then we estimate based on market values what the annual fee would be. And then on the far right is just those investments, those types of vehicles. We take the median of that. All that goes down. You find the first horizontal blue box going across, paying about 39 basis points. So called about $81,000 annually. And that's just a little better than those types of investments and those types of vehicles of 40 basis points. So obviously you have a lot of indexing and you have some active management, some alternatives. So you kind of have a good balance there to keep your fees very reasonable. You have our fee and you have regions, and it all ends up there on the bottom line there for your investment program.
That investment consultant.
Yes.
That's one.
I would say it's pretty low. You got a longtime client discount. I'm going to say that. Any questions on that? Okay. So next, obviously that next section, we got through that pretty quickly, which was my goal. So we can kind of spend a little time on just kind of where we go from here and thoughts, and maybe the answer is we do nothing, and that's totally okay. So the next section is Exhibit 2, and this is kind of abbreviated output from our asset allocation software. Page 2 kind of runs through what the software does and kind of the impact there. What we're trying to do, obviously, you have a return target now of 7%. It was 7.25, now it's 7. So you run 1,000 different scenarios based on all these different inputs, and it spits out expectations of different asset classes based on kind of historical things that have happened in the 20th and 21st century, based on kind of different variables. So that output from a capital markets assumption standpoint is on page 3. And I see everything is a distribution curve. Obviously, we're not saying core bonds are going to return 4.8%. We're saying that's our expected average return from this point where we are going 10 years forward. So all the current asset classes that you have, plus an additional one based on our discussion at the last meeting, you can see on there. So at the top, so core bonds, 4.8% is the go forward expectation. Most recently, volatility, 4.7%. Kind of go down the list.
Is that just standard deviation? Is that what you're referring to, standard deviation?
Yes.
So,
So obviously lower is better if you can get if all things being equal. So going down the list there, in fixed income, you can see high yield bank loans kind of leading the way. Not a surprise because those have obviously spreads off of treasuries and your expectations on core fixed income, but higher volatility. U.S. equities, U.S. large cap core, the go forward from right here is about 6.9%. You can see volatility is 16.6. And you go down the list, you can see some of the other kind of asset classes, sub asset classes within equities have a little higher expectation just because they have certainly lagged and missed out on a lot of this run overall, but they do have higher volatility expectations. Non-US, similar story. Obviously, that has lagged US for at least a decade plus now at this point. So you can see on there expectations going forward. Core real estate, 6.5%, extremely low volatility. Obviously, we're right now not really in a low volatility environment right now for real estate, but you look back with history, it proves out. And then your alternatives, private debt, which is one thing I was asked to look at for this meeting, as well as private equity fund of funds, 11.1. Obviously, there's tons of different flavors within there. So this is just kind of a high level look at those particular asset classes. But you can see obviously the expected benefit of from a return standpoint and volatility standpoint of those asset classes. Obviously, the trade-off is liquidity. So particular funds, if you need the money, you're not going to get it when you need it. But we do think overall, obviously, we've implemented private equity already and real estate long ago that those do help out a full balanced portfolio. The right-hand side is just kind of think of a distribution curve based on each one of these different asset classes. So obviously you have from the 5th percentile, 95th percentile, and everything in between. So that's kind of the building blocks of the next page. So the next page, page 4, is we have your current targets and your current allocations going all the way down on the left-hand side with those asset classes. So your current portfolio, as it's currently constructed, our average expected 10-year return is 7.86%. So it definitely got some clearance over that 7%. Volatility of 10.85, and then that number beneath that is just your return divided by volatility. So kind of like your miles per gallon on there. So last meeting, when we reviewed this and just kind of did a high level look at things, we looked at scenarios that actually increased fixed income. Reason that we did that and are doing that with clients, obviously you're already at 30%. So you're not having to journey from the depths of 20% onward. But the trade-offs right now on a go forward basis between core fixed income and US equities are as narrow as they've been since before the financial crisis. So we're kind of looking at things, the way to kind of de-risk a little bit, for clients that say, hey, we're at 7.86. We're, obviously we have a 7% or 6.75% return. We're comfortable getting this down to 7.5% if that knocks down our volatility considerably from this point forward. So we kind of ran through that. And then the direction that we talked about at the end of the meeting was we zero in on that preferred stock part, because that obviously has not done that great. It's shadow equity itself. We added bank loans. We have the high yield in there. We don't really need something like preferred stock in there, especially with where core bonds and core plus are. You're getting the yield there at this point. So we just want to zero in on that at this meeting and say, what if we take that 4% and do other things with it effectively? So option A is taking that 4% out of preferred stock and basically layering that 1% into each of the existing fixed income classes. So core goes from 9 to 10, core plus goes from 9 to 10, High yield goes 4 to 5, same with bank loans. Everything else is the same. And you go all the way down to the bottom. It actually increases your expected return and decreases your expected volatility. That's a win to me, but so you can see obviously 0.73 there. So it's super easy. And to us, moves the needle there. The other options that we were asked to kind of look at was what if we take that 4% and actually shift that down to private equity? If you go on to option B, that's what that does. And then I just took the liberty of also decreasing some of the overweights to small cap. You can see that bumps you all the way up to 7.98. And your volatility does go up a little bit from there, 10.85. The issue with that, just in general, as we can run through, is that knocks out 4% off principal. So your cushion now gets down to like $200,000 and change, which maybe you feel comfortable with. That's kind of low. Option C is still that 4% is gone. And that one basically kind of replicates almost what was going on in option A. There's a little more in core, but keeps those assets keeps that 4% in fixed income. But then I do that little twist of reducing some of that overweight to small cap, mid cap, and that just bumps up to basically the S&P 500 at large cap. Same on international. You go from 4.5% EM to 3%, and 4.5% non-US to 3%. That just bumps right up to the broad US. That gets you in at 7.75 and knocks down your volatility to 10.47. So based on where you're at from the current, it does knock down your return about 11 basis points. But you can see your volatility knocked down pretty considerably from those tweaks. Option D is just going straight that 4% from preferred stock down to private equity. This is more kind of aspirational at this point based on my prior remarks. You can see that bumps you up over 8%, volatility at 11.07. And then option E, I was also asked to look at private credit and just kind of see how that would map out. And you can see there 8.05 and volatility of 10.81. I mean, that's probably the best, one of the best looking portfolios there, adding in something like private credit. But as I mentioned, and I have this, I think it's we just jumped to exhibit 3, page 1, just so I can I'll be on the same page here. This is the benefit index if that 4% in preferred exits principal. Can go equities at Regions, it can go to private credit, private equity, it's just gone. So in the bottom right, you can see the cushion gets down to about $250,000 on there. So it's obviously pretty low. So jumping back, sorry to give you whiplash here, jumping back to page 4 in that prior section, exhibit 2. Thank you. That's kind of where we are right now. Status quo. You want to make a tweak? Discussion, the floor is yours.
Well, I think we need to sort of, prioritize the priorities. That was good. I like using that word twice. So I think, what is the number one priority? One is from here, is it to get out of preferred stocks? And if the answer is yes, committee feels, and you guys are consultants and you say yes, okay, then where do we put it that 4% that best helps us? However, you've also brought up that we are overweight, and you're feeling in small cap and mid cap. So if we reduce those numbers, we can do that and stay within and move it. If that's outside of principal.
Correct. Everything is.
So we can move that preferred stocks in principal, correct?
Correct.
Yeah. So how do we reduce that, which is is that a bigger priority? Is that a smaller priority? Sort of rhetorical. It is rhetorical. In doing so, and where do we put, where would, if you lessen the mid to small, because if you go from 4%, well, if you go from 8, are we going from 8 to 6? Are we going from, and so those are, you know, what do we want to get to? What's the end goal
Mhm.
on that? And then I know we're trying to get, as you put in the email, lowered in real estate. What's our target to get into real estate? And when we get that real estate money,
Mhm.
because that's at principal,
Principal.
right? Do we put that into the fixed income so we stay? I mean, I know you took it out and you put it in the bank, which is great at getting the 5%.
Small, yeah, that's small part.
Right, but do we keep that in the bonds because we have to keep it with principal? So I mean, there's like 3 or
Yes.
4
Oh, yeah.
different parts.
There's a lot.
So we've got to prioritize, because I don't think we can do it all at once. Maybe we can. Maybe we can accomplish this. And we also wanted to get levered debt, correct?
Yeah, potentially.
That, I think that's a,
I mean, which I think we'd like to do, but
there's
we're
a now and
handcuffed.
later. I think that's the later.
Yeah, I think, is that the lowest priority at 4, at the,
Yes.
you know,
And a couple different things to further
Yeah.
confuse the point.
uh-huh.
So on private credit,
Mhm.
the options that we have right now are limited because of our size.
Because we're now below 25 million.
Yes.
Yeah.
Private equity, because we're kind of like grandfathered in.
Yeah.
We got in like right at the
Right.
right moment, the exact right moment. That would be easier to add to. Like we have like 4 or 5 different managers that kind of evergreen private credit strategies, and they're sprouting up like weeds everywhere, and you probably know that. There's like 2 right now that would say, okay, based on kind of where you are at and all these things, we could work it out with you, but there's just not a lot of options. in
Right,
private
but is
credit.
that where does that fall on the priority list?
Like in the parking lot, right? now.
Okay, so that's sort of out there.
Yeah, I think once we
Okay.
get to a point where we're able to start getting significant distributions from real estate, and
Mhm.
we're not there yet. Because right now, the requests we have in, we're at like 12% or change or so. The requests we have in get us down to about 10%, which is the current target.
Right, but is that the right target?
No,
And that's what I put
no,
in my email. What?
we
if
we
we
could
could-
model that, but
Yeah.
right now it's kind of pointless because
And I'm not saying because real estate's gone down. I just think that if you're, as I said, if you've got the alternative assets.
Yeah.
And real estate, where we're going, I think that's real estate's high.
Yeah,
In my opinion.
absolutely.
Yeah.
And
And I think you agreed.
And why was
Yeah.
it? Obviously, interest rates were lower. Your availability to access private equity, private credit wasn't a thing 10 years ago. Now it is. So or mostly with private credit, but
Right.
you have more options now.
$25 million can get into private credit.
But we don't have the money right now to get into private credit.
Why don't we borrow $4 million from the
Okay.
general fund? And that way, that's what Trump would do, right?
No,
Jennifer, don't even listen to, can you?
Well, what
mute him?
interest rate, was
If you
the
could
city
mute him,
charge?
that would be great. So I think that's I think unless somebody disagrees or has a solution or whatever, I think that's I think we need to prioritize on where we go with this. And I think we need to get, where are we ending up? What is the target? It might take us 2 years to get there, but what is the target? Where do we want to be?
Mhm.
And then sort of back into how we get there, what the priorities are.
Okay.
and before, can I just ask
Sure.
what is most likely a simple question? What is the cushion that we want to keep at principal? Because you're saying if we move the preferred stock out, then we reduce our principal from, I think it was
The-
260 to 230.
Yep.
What's the
So
target number?
that number has gone down through the years as we've had less equity exposure in there. So right now you're at about 1 million. I feel like that's kind of roughly where everybody, it's up to you guys to decide.
Mhm.
But that is a pretty solid cushion. If you get that down a couple $100,000, I still think with kind of what you have in the portfolio being fixed income, and then obviously real estate's taken some pain, but hopefully most of that pain is gone for now. That's still reasonable.
Yeah, and that's not a
200.
market timing thing to get out of real estate. It's just,
No.
I think overall that we've got too much in real estate.
It's, yeah.
Even if real estate was
it's-
doing
It served its
gangbusters.
purpose. everything, things have changed. We still think it makes sense to be in portfolio. Absolutely.
Agreed. Agreed.
Don't want to blow out of it, but you have the ability to invest in other things, and if you can, I'd be excited to show you those things and to get you in those. But right now, probably
You
not.
were gonna say something.
I was gonna say, what's not illustrated in the cushion is if we move preferred to fixed income within principal, that's gonna increase our cushion, right? Because it's a
stay the
higher volatility
It'll go up a
factor.
little bit. Yeah, it'll go up a little bit. It wouldn't move the needle too much because you are.
You're going from like
preferred to
0.75 to like a
0.75 up to,
0.95.
you know, call if it's a core. I think the scenarios I had were core and core plus, so 0.95. So we'll go up a little bit to do that. In a couple of scenarios, I think I even had, 1% going out to bank loans. So it'd be a pretty much.
Just
a
one other
wash.
comment that I have that maybe you guys can back me on, but
Yeah.
the private equity over time is just gonna organically grow because the drawdowns aren't as much and it also returns when equities are up. So I feel like a lot of our client portfolios that have private equity, like they're overweight right now in private equity
yeah.
and it's hard to scale that back too. So just over time, that's gonna grow
Mhm.
naturally.
True,
is-
very true.
So
Very true. So, so as we sit here, obviously, and a couple of meetings ago, and we did this, I think I did present some scenarios with lower real estate. And it was just viewed as kind of more aspirational. So I was told to not do that. Not thereafter. That's why I didn't reduce.
No, I understand. But I think we should look at where we want to be like 2 years from now.
Yeah.
What's the portfolio, the allocation that we want?
Mhm.
And I think that would be very helpful.
Okay.
And then we can shoot for that, and with the limitations and the restrictions we have, we can
Mhm.
massage it, and then we can prioritize sort of how to get there based on your recommendations. I think we ought to, do X, reduce the small and mid cap, and I think we ought to put it here type thing based on where we want to get to in the next couple of years.
Yeah, I'd say if assuming we bump up private debt, private equity, obviously we're not trying to get an endowment model here where it's 40% in alts, but bumping those up, I think a 5% slug at core real estate is reasonable. Basically cut it in half.
5%.
Basically cut it in half. It's there. It'll
Uh-huh.
do what it's supposed to do.
Yeah.
it seems to me the option C that you have mapped out here,
Yes.
where we keep the preferred within prudential or within principal, where we at principal?
Principal, yeah.
Principal.
And then if you're suggesting the overweights within the equities, that doesn't do anything to our cushion. That's all in Vanguard.
That impacts, so it would be a net positive, I believe, to the cushion because
Because we're moving from preferred up to the higher.
Yeah, bank
quality.
loans do go up from 4 to 4.5, and that's external, but just thinking about the numbers, it'd be a net positive to the cushion.
So I would suggest or move to option C, and then as we get out of real estate, start diverting those dollars out of principal to private equity, or if we ever get to the private credit bogey.
To take it, then if you want C, is that where we want to end up if we could write our ticket without any restrictions? Is that where we want to end up with mid and small?
Yeah, I think we're taking the recommendations of our.
I mean, I'm
If
saying.
not,
You
just
still have a bet on there, and that maps out on our estimates positively. It's just not a extreme bet, which I think is more reasonable.
Where would you like us to, that's what I'm saying, where would you like us to be? What percent small cap?
So right now you're 9 out of 30,
Mhm.
37. Let's see.
25%.
So 6. So 6 divided by 37. I got you here on option C at 6 out of 37, which is 16%. So it's not quite a 100% bet on it from where it is. If it's 8 or 9%, you go up to 16. That's a bet. It's just not.
Well, we don't, I mean,
Tremendous bet.
we're not smart enough. You're not smart enough. We're not
You
smart
are,
enough to know
but-
to take those bets. So, I mean, that's why it's market weighted and all that kind of stuff. So if we
Sure.
feel we should go lower than that, let's go lower than that. And that's what I'm asking you. And you don't have to tell us today, but, same thing with mid cap.
Yeah.
If you feel that we should reduce mid cap and that, I think that, I mean, that's fine. I'm not gonna sit here and say to you, no, and we're talking de minimis, I understand.
Sure.
But if you feel that, we should be overall 5% small cap and 6% mid cap,
Yeah.
then that should be our target to get to.
So, yeah, page 3, once again, if you look at kind of how we project, and obviously projections and estimates are gonna be wrong.
Mhm.
But you kind of look at the lower caps, 7.8, 8.1 on estimates for small. The large cap core is 6.9 and mid cap is right in the middle there. So, our numbers say, obviously, our numbers are our numbers and everybody has numbers. Say that, estimates are that will outperform in the long run. Obviously, the past 20 years, it hasn't. The past 100 years, yes, it has, but what
Yeah,
are we talking about here? Obviously, we can talk about obviously, 401k and all the flows that are going into S&P and just every day, the amount of money that's flown in the S&P versus the other indices. But be that as it may, we do think if you're going to do this, have a little bet there.
So when I think about what really hurts us is volatility. And when I look at the average annual returns and Elon's volatility, I start to think, and I gotta tell you, years ago, I was a big fan of emerging markets, small cap. But where things are right now, are we putting ourselves in more risk by having our stuff?
Yeah, I mean, EM, it's been kind of I'll use a finance term, dumpster fire. Obviously, past decade plus, obviously there's been pockets of time where, early 90s up 90%, 80%, 70%. And obviously you missed that, whatever.
But in a portfolio, if you've got 3% emerging markets, it's not moving the needle.
It's not
regardless.
like it just, kind of the holistic look at it. I mean, I do have some clients that have exited emerging markets for different reasons, for political reasons and all the reasons they're within. At 3%, right now you're 4.5%. So pulling that out completely, that is gonna impact the portfolio, because you do have 4.5% there. Obviously, your returns would go down, volatility would go down too. But if you get to a 3% range there, it's obviously you have the access, you have the exposure. But if EM blows up, you're not going to blow up
Right.
with it.
So here's what I look at, and I look at if you want to keep it non-US equity, okay?
Mhm.
If you want to keep it, non-US equity, and you move it from emerging markets up to broad non-US equity, you basically reduce your volatility by 11 points, and you basically only lose 1 point for the positive side. I'm asking, I don't know if I'm thinking about it properly or not.
I would love to show you guys like 50 different scenarios that kind of contemplate all these things. So here, today's focus was kind of these 5 things and based on, but I would love to do those things if you just give me the green light and I can give you different scenarios. But today was just focused on pulling preferreds out. What can we do?
Right, but I also would, I mean, again, you're the consultant. I don't think we're gonna sit here and, well, I look at Mike, but and bang our chest and say, no, we want 10 different options. I mean, I think if you came with, this is really where you've been doing this for us for how long? How many?
Long decades.
Right. So our plan, you've been with us, right?
Yep.
So if you came to us and said, this is really the model, this is where I'd like us to be in a couple of years. We want the small cap reduced to this, we want emerging markets, we want this, this, and this. I don't think we need 5, 10 different scenarios. I mean, I think if you gave us that one thing and said, we really like this and we're confident, I don't think we're gonna.
Sure.
Is option C pretty close to the Russell 3 in terms of the weightings?
It's a lot closer. Yeah, it's a lot closer. I mean, when we look at portfolios that are trying to hit over 7% and they don't have a reason that they've told us to omit emerging markets, we're not omitting.
That's fine.
It's in vast majority of portfolios, but
I don't disagree with you.
But if you
Yeah.
say,
No, we're
I
not
wanna
saying
see
get rid
what-
of, we're not saying get rid of, we're saying, bring us a portfolio. I don't need 5 different options. I need one option that you say, this is what we really, really like.
But I would personally, if you were to say, I don't want to use the fact that everybody else has emerging markets as part of it.
But if you as a, as a
But
firm,
our
if our
firm,
philosophy,
yeah, our
you like
firm
it,
has it. We don't, we have, some of our peers have gone crazy overweight that because they're like, it's due.
yeah. I
We're
don't-
not
as you-
doing
as I
that.
said,
We're
I
not
don't
doing that.
believe
That's
in what's
not
due.
us.
I don't believe in this
Yeah,
whole thing, you
That's,
know.
that's not us. But obviously we have, so I think about OCIO portfolios, where obviously we do, you know, we do everything. Real estate is probably somewhere between 5 and 10%.
I mean, if you
on
want
its
real
way
estate at
down,
5, it's fine. I mean,
5 to
that-
10%.
Yeah,
If we can get private debt or private equity access, 5% here or there, it's probably in there if we can access it. Internet, usually the ratio of US equity to non-US equity is kind of usually around 2 to 1 US to non-US. You're
I'd even
there.
tell you to go more US.
No,
This
yeah.
is, this is exactly how we have our client, our current portfolio is
Yeah.
exactly how we model our client portfolios for equities.
Yeah.
It's like 2/3 the domestic and then
Mhm.
33, 33, 33.
Yeah, and so we have charts going back to the 70s when, you know, all the, you know, international indices kind of came on and you kind of look at the, you know, risk return paradigm and, you know, the 80% or 70% US and non-US historically has the best risk adjusted return. Obviously, if you were 100% equities, you'd tick up on the return, but your volatility shifts all the way. For
You
you,
know,
it would be this way.
But if you buy Apple Computer, how much of their revenue is international?
Correct.
I mean, so-
obviously you have that.
You've got that. So I mean, it's not like you need to have this huge bet international.
Yes. So true.
I mean, you're already betting international by buying the S&P 500 because I mean, everybody's doing business internationally.
So, yeah, so at our symposium,
Mhm.
we did a long presentation on kind of the decoupling of the world from a supply chain. The world is pulling apart. So we showed correlation US, non-US, and you know, the correlation is in the 90s, but in the 90s, it's trended upward. So our theory is, as if the world continues to start pulling apart, friendshoring, onshoring, nearshoring, all that, we likely will see more of a decoupling of returns between US and non-US. As you know, obviously it takes a lot more than just saying, politicians saying we're getting manufacturing back on our soil, but our belief is it's not going to get more correlated from here on out. Could get less correlated.
I mean, if we would have thrown on international last 10 years and just put it in S&P 500, we'd be in great shape right now.
Yeah, we should have just put it in large cap growth and
Let it
7
roll.
stocks and just,
Right.
you know, we'd be sipping Mai Tai somewhere.
Yeah.
So it'd be great.
Exactly.
I moved
So-
on Microsoft.
So anyway, that's what I mean, I don't think we have any, we're not going to come here with, we don't have any bias. I don't think you, Josephine, we don't have any bias. So,
Yeah.
you know, we've hired you. We want you to come. We all have our philosophies, right?
Sure.
We have each different firm has their own, but we're not here to say, this is what our firm does. This is what we want you to do. Because that's not, I mean, you're the consultant, so that's what we're paying you. Come to tell us what you really would like us to do.
Within the constraints of your
Obviously.
principle. So that's
Until we
that's
can
a
get out of
different-
principle,
it's a diff-
yes.
There is that factor.
Which we have to play with right now.
Yeah.
Unfortunately. Yeah, within those constraints, and this is where we'd like to get to. And as I said, if you think it's 5% real estate, great. If you think it's 4, if you think it's 6, that's fine. If you want to, you know, if we want to mirror the Russell 3000 and we want to only have 10%, you know, small cap and 10% mid cap and 80% large, then that's what we should do. If that's what you feel we should do.
And obviously you have index funds, but you
Mhm.
have, and we talked about, you have mid cap and you have small caps. Obviously, the history of that is you had mostly active managers in each of these sectors, and through the years, you know, one manager underperformed or there was a manager change. Okay, let's just index it. So you
Right.
indexed here, indexed here, indexed here. Now we get to this point and it's all index funds. You know, we have plenty of clients who just, they have the all cap index fund. And they focus on managed performance in fixed income, beating the ag, adding private assets, working on that, making sure they get access to good managers there. International, they'll probably go active there. Maybe small cap, they might try to add a little active exposure there. And that's it. None of this mid cap value, small cap growth, dancing all around there. I mean,
Go for it.
that.
I mean, I'm not saying that, yeah. I mean, this is way we want to model the, manage the portfolio.
Yeah.
Because then when it doesn't do well, we can blame you.
It's perfect. That's what I'm here for.
But yeah, no, I mean, let us know what you really want to do. I mean,
Okay.
obviously we have constraints, but
Yeah.
because of principle.
Yeah, I'd say, as we sit here today, option C, I put that in there. Cause that's, I believe, getting us to where you
That's
should be.
great. That's
But like I
great.
said, obviously, I'm not gonna say 5% core real estate because that 5% comes from somewhere else. And that's not gonna be touched for a year or whatever it may be.
Mhm.
But we can,
Again,
think through
we're
things.
working towards,
We can
this
think
is
through
the
that.
model we're working towards.
yes, we can do that.
Okay.
Is there ever an option where we can fully exit principal?
Like,
No.
There-
not
there's
bad.
never-
We-
there's
we
never a
have-
scenario
maybe
where
find,
we
you
have
find
to-
somebody else to take it over.
No,
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 I mean,
no.
like, we just can't.
We can't, I don't think we can ever leave them.
Yeah.
You don't,
kinda like,
I don't know if you've read the contract, but
I have not read the contract, but
I have.
I thank you for reading it.
Yeah, well,
Yeah.
it was,
We were
we
talking-
tried
I
to fight
didn't
it.
know if we were talking
I
about
have
that.
another idea to try and fight it.
Yeah,
But
I don't-
'cause I
I
don't
don't
think
think
it's
so.
legal what they're doing. I really don't. I mean, we've had it for 50 years. To sign a contract that you have to be with somebody in perpetuity
Yeah.
is really uncapitalism. We are in America.
The flip side, it does protect the employees per se. But
How's it a protected employees?
because it annuitizes the assets.
I understand, but we've been handcuffed and with our rate of return, so we've actually done poorly or worse than I think we would have done. If we weren't handcuffed and we've had more money, which makes the plan more secure. So I'll play that. I think. Anyway, I interrupted Jennifer.
No, I think we cannot get out of principle, unfortunately.
I've got an idea, but I'll work on that behind the scenes.
I'm gonna take my opinion. and forward.
Well, each month we get closer to the end of that as well as the pearly gates. So I guess that's the good news is we're continuing the progress.
Okay. Good. Or is there anything else we need to?
In the event that we don't do anything, it sounds like that we do need to raise a little cash
Okay,
to replenish. So if you go to exhibit 3, it's just the last
last
page.
page.
It's the it says City of Olivet, if portfolio stays status quo, as if I knew. So if you go on here, suggested changes, recommending, so basically replenishing the principal core fixed income, which that gets depleted. So we do this almost every quarter. So that recommending 525,000 into that, get that back up. Still below target, but gets us another few months. And recommending 200,000 from the S&P 500, 50,000 from our friends in EM, 50,000 from preferred, 100,000 from high yield, and 125,000 from Pacific Bank loans within there.
Is the bank loans liquid or is that a
Yes.
redemption fund?
Yeah,
Okay.
it's mutual fund. It's mutual fund daily liquidity. So just doing that exercise, we're over target and some of those, most of those replenish that and
so I go back to my question, and this is fine, but if we want to reduce our small exposure,
yes.
is this a time to do it instead of taking it out of S&P?
Do you want to do that?
I think that, as I said, I come back to
Yeah.
you and you're our advisors.
Yep.
Would you recommend that we start reducing our exposure to small and mid and move around international? Would you like to come back to us? Because I think we can do this through email. Can't we?
Yeah.
Can we do it? We've done it before.
Making a decision via email?
Yeah, if they come back to us,
So this is our
this is our recommendation next week, and say, would you prefer to do that, or would you like?
No, you have to do that in a public meeting.
We haven't done these versions.
Yeah, we,
Yeah, you can have a virtual meeting if you would like, but you can't make a public policy pension decision via email.
have we done it before, Darren? We had.
Who was it? Was it COVID?
Virtually?
Yeah, and then we've got a short meeting before we, virtually get 4 people.
So there's just gotta be a
I
quorum.
mean, I don't want to break the rules, so that's the last thing, is send that that important for us to break the rules.
So,
Yeah. Let's,
so if you're willing to start working towards small cap or at least entertain that thought. So you are currently on small growth. I know the font is an eye test.
Here, you
Small,
want to look at my screen here?
small
Growth's
growth,
down to 4%.
small growth, you're about 111,000 under target. Small value, you're only about 13,000 under target. So just to equal that out, we could take 100,000 from small value. So then they're about equally underweight at this point.
Okay.
And then still take 100,000 from the S&P. We're just not taking it as much of that.
Mhm.
So then we're kind of doing both. So 100,000 from S&P, 100,000 from small value, and all the other ones stay the same call today.
Do you want to take more out of emerging market?
Do you? I mean, we could take,
I
Make
mean,
it
if you want to get
100,000,
down to
if that-
3% and we're at 4.5 right now,
that'd be fine. That'd be fine. So based on this,
take 100 from small and take 150 from emerging market.
let's see, so we gotta get to 250. Yep, let's do that.
We have a motion.
okay,
to-
hang on. So let's keep some record keeping for the new person here. So, oh my God, can we print?
That's why I'm looking at the screen,
Oh,
Jennifer.
no. So if you could write it down exactly
Yes.
what we were doing and then. Yeah, we'll make a motion as presented.
Oh, I see
So
what you're saying.
right
You want
now
us
you
to,
have-
here. Where'd my pen go?
Yeah, the motion
I had a
otherwise
pen.
get messy. So.
I thought I had a
I'm
pen
going to
here.
Make
I
the
thought I brought a
motion as a
pen.
member, but. So we're taking 100,000 out of small growth, small value. And
150 out of emerging
150
market.
out of emerging,
And the other changes.
the same. Okay.
We just canceled out that.
Okay. So
And Partners Group is already. up
is
to
there
7.2.
agreement on the board
Yeah,
that
so
this
they
is what
go
we are
south.
gonna do?
I mean, the drawdowns aren't as bad.
Am I getting noddings of heads? Okay, so I'm gonna make a motion that,
You're stealing my thunder.
I'm sorry,
I'm joking.
I'm the new person, I'm allowed. That we will take $100,000 out of small value, $150,000 out of emerging markets. The remaining changes as suggested will stay the same. We are not going to do the $200,000 reduction from S&P.
Yes,
Is that correct?
you were
Yes,
correct. 100%.
Okay, so then if there's a second,
Second.
and then you can,
Any other discussion?
No,
All in favor?
aye.
Any opposed?
no.
Okay,
All right, perfect.
so next meeting.
Next
we will come back with big picture, future state.
Yeah,
Thought.
where you'd like, this is where we really would like you to be.
Okay.
Yeah, I think that would be great.
Knowing that we won't get there for,
Yeah, knowing that we're, our hands are tied, it
Knowing
might
that
take
it-
us years to get there, but this is where we want to be. And we could make some moves, again, if you think emerging markets should be at 3% and we want to do it all within Vanguard, that's fine. I mean,
Yeah.
we can do that, but knowing that there's a bunch of it that we're not going to get to. And that's why I
Okay.
said sort of prioritize.
Okay.
Yeah. So good. All right.
Okay, I move we adjourn the meeting.
Is there a second? Is there any other discussion that we have for the meeting? Because I think we've been through our agenda. Right? Schedule next meeting is February 1st at the normal time, which is the first Thursday of the month following the end of the quarter. Or the month after the month following the end of the quarter. Excellent.
I'll second the motion to adjourn.
Sounds good. Oh, no, I get to hit the bag. We're done. Thank you. Thanks, guys.
Listen,